Growth of these services pose risks to financial stability. What does all this information mean for central banks? Today, we are fortunate to have two distinguished panelists discuss the impact of digital data on financial markets and financial intermediation. Let me briefly introduce our two panelists. Robert Merton is the School of Management Distinguished Professor of Finance at the MIT School of Management and the John and Natty MacArthur University Professor Emeritus at Harvard. After receiving his PhD from MIT, Bob served on the finance faculty of MIT Sloan School until 1988, at which he was the J.C. Penney Professor of Management. Bob received the Alfred Nobel Memorial Prize in Economic Sciences in 1997 for his work on asset pricing, including the pricing of derivative contracts. He was president of the American Finance Association, a member of the National Academy of Sciences, and a fellow of the American Academy of Arts and Sciences. Agustín Carstens has been general manager of the BIS since 2017. That means he was my boss at the BIS, and it was my great pleasure to work for him. Before joining the BIS as general manager, Agustín was governor of the Bank of Mexico. That was from 2010 to 2017. He chaired the International Monetary and Financial Committee, the IMF's Policy Advisory Committee. He was also deputy managing director at the IMF from 2003 to 2006. And he was Mexico's finance minister from 2006 to 2009. That means that unlike Janet Yellen, he was finance minister before he was central bank governor. So let me just do this alphabetically. Let me now invite Agustín to offer his initial remarks. Agustín.
Thank you very much, Eli. And first of all, let me offer my greetings to Tansri Sethi, to Charlie Fine, Dean of the Asian School of Business, and to Eli Ramalona, and thank them for inviting me to this very interesting panel. Of course, with Bob Merton, it's a pleasure to be with you again. And also to say hi to some of my very good friends, ex-governors that are present, Jacob Frenkel, Athanasios, Patrick, and a few others. So it's great to be here, and this is just the testimony of the tremendous job that the Asia School of Business is doing in this program on central banking. So what I will talk about is public policy for big techs in finance. I think this is a very important topic, very timely topic, and hopefully this will stimulate some discussion. The financial sector has always been information hungry and an avid adopter of technology. It is said that in the Renaissance, Venetian traders were among the first adopters of the telescope to keep watch for incoming ships. Early information could give traders an edge in buying and selling assets. Financial institutions were also among the first adopters of the telegraph and of satellite images, again aiming to achieve an information advantage. Over time, the volume of information available has grown and grown, and finance has continued to use this information to allocate funds and risks in the economy. Is today any different? We have smartphones, machine learning, and blockchains, but are we seeing fundamental changes in the role of information? In my remarks, I would like to focus on one thing that has changed, namely who is offering financial services. Recently, we have seen the entry of big techs, which are able to exploit their massive data, networks, and range of activities. The entry of big techs requires a comprehensive public policy approach that combines financial regulation, competition policy, and data privacy. Big techs have done something quite remarkable. Within less than 2 decades, they have gone from startups to dominating a range of markets. This is unprecedented. Today, the reach of big techs extends across a wide range of industries, of which finance is only one. That is seen on the left of the graph that is in front of you. Indeed, financial services make up only 11% of big tech's revenue so far. And to quote the Latin proverb, nomen est omen, that is, the name is a sign, they have become very large. As a result of their control over key digital platforms in e-commerce, search, or social media, big techs are able to gather, process, and communicate huge volumes of data. Not surprisingly, they have become among the largest companies in the world, operating in multiple jurisdictions. As seen on the left, big techs like Google, Apple, Facebook, Amazon in the US, and Alibaba and Tencent in China have market capitalizations that far surpass those of the largest banks. So why have they gotten so large? Big tech business models rest on enabling direct interactions among a large number of users. This may be in e-commerce, such as Alibaba and Amazon, social media, such as Tencent or Facebook, or search, such as Baidu or Google. An essential byproduct of their business is the massive user data they collect. They exploit natural network effects, generating further user activity. As an example, payment services generate transaction data. Network externalities facilitate the interaction among users, and this helps serve the needs in other activities, such as credit. But these activities will provide further data and will fuel again the data network activities feedback loop. Data analytics, network externalities, and interwoven activities, something that we call here at the BIS DNA, constitute the key features of big tech's business models. These three elements reinforce each other. The DNA concept helps us in two ways. First, it helps us to compare banks and big tech's business models along these three dimensions. Second, it can help us to understand the main benefits and challenges that arise from the entry of big techs in finance. Among benefits, these features of big tech's business model can be very powerful to enhance efficiency and financial inclusion. For example, the use of detailed user data from other business lines may reduce the need for costly collateral for loans. At the same time, the DNA loop entails risks for privacy and consumer protection, market contestability, and eventually financial stability. That calls for a specific regulation for those entities. That could also help reduce distortions vis-a-vis bank. We know that public policy should maximize welfare. To do this, public policy typically sets some intermediate objectives, such as efficiency and fair competition, financial stability, market integrity, and consumer protection. The growth of big techs is rapidly changing markets and posing challenges from the perspective of each of these public policy's objectives. Let me give you a few examples. First, while big tech's entry into finance can initially bring greater competition, they can quickly scale up and dominate markets. They may also have conflicts of interest from their financial and non-financial business lines. Competition policy may have to adapt accordingly. Second, and on a related note, they could quickly become systemically important or too big to fail. This may already be the case for the largest mobile money providers in China and the major cloud service providers serving financial institutions. Third, with regard to market integrity, there are challenges around anti-money laundering and combating the financing of terrorism. This is particularly relevant in the light of new digital payment services, such as Facebook, Libra, now Diem proposal. Fourth, big tech's use of data can pose challenges to consumers. While detailed data allow to reduce asymmetric information problems, there are risks to consumers when sensitive data are shared. Moreover, big tech can engage in price discrimination, making consumers worse off. Restricting the use of data may help, but could have cost for efficiency. Overall, it is clear that big techs put policymakers in a thorny position. Thus, authorities must consider how best to adjust the regulatory framework to address the risks posed by the operation of big techs while preserving the opportunities they create. In the interest of time, let me elaborate on issues related to competition, namely the need to promote a level playing field with commercial banks. This is important, subject to maintaining financial stability, market integrity, and other relevant policy objectives. In the current framework, big techs must hold licenses to offer specific financial services, such as payment services, wealth management, credit underwriting, and some other. That obliged big techs to satisfy rules affecting all providers of those services. Banks need, in addition, to satisfy prudential requirements, entity-based obligations that affect all services they provide, even if those activities are performed through non-deposit taking subsidiaries. The notion is therefore that the current framework may affect the competitive position of banks vis-à-vis the new players in the market for financial services. Any regulatory discrepancies across different players need to be justified on the basis of solid policy ground. In that context, the banking industry and some regulators are promoting a move from an entity-based to a more active activity-based regulatory approach. This line of reasoning often ignores that big techs are already satisfying activity-based requirements, as I mentioned already, particularly in the areas of AML, CFT, and consumer protection. Moreover, a pure activity-based approach would allow banks to exclude certain non-deposit taking activities from the prudential regulatory perimeter. That runs against Basel core principles under which banks should satisfy prudential requirements based on all activities they perform. This would also run against actions taken after the great financial crisis to enlarge the scope of bank supervision and to further protect core from ancillary activities. More importantly, the main risks that big techs generate have to do with their unique DNA-based business model that combines different activities like e-commerce, financial services providers, cloud computing, etc., and their large size, systemically importance. Those risks can hardly be addressed by a piecemeal activity-by-activity approach. Therefore, the widely used slogan, same activity, same regulation, cannot constitute by itself the basis of the required regulatory reform. Activity-based regulations do not provide the full answer to all relevant policy challenges posed by big techs. We have to take one step further. Indeed, there is a relatively large scope to address the risks of big techs by directly regulating them, i.e., developing specific entity-based rules on top of activity-based rules. That approach would be more powerful to achieve the primary objectives of regulatory policies, but also help to mitigate competitive distortions between banks and non-banks. Elements of an entity-based approach for big techs are already present in recent regulatory initiatives worldwide. In particular, a subcommittee of the US House of Representatives published a list of recommendations to regulate big techs in October 2020. In November 2020, the Chinese Administration for Market Regulation published a set of guidelines for internet companies for consultation. Finally, the European Commission published proposals for a Digital Services Act and a Digital Markets Act in December 2020. The proposals contain specific provisions that aim at preventing data misuse and anti-competitive practices by big techs. That is a significant departure from usual practices. Competition policy does not typically rely on specific rules to be satisfied ex ante by firms. It rather builds on the ex post monitoring of the application of general principles and the development of case law. The initiatives by the Commission also include provisions for risk management procedures, transparency, auditing exercises, and the supervision of big techs. A natural follow-up of those initiatives is to further study possible measures that address the potential systemic relevance of big techs and the need to introduce specific safeguards to guarantee sufficient operational resilience. That may be especially relevant for big techs offering key services, such as cloud computing, to financial institutions worldwide. That action would need to address a number of specific challenges. At present, the notion of systemically important financial institution is almost exclusively applied in practice to traditional financial institutions, banks, like banks and insurance companies, and the notion of systemically important financial market utility is likewise applied to market infrastructures. In some jurisdictions like the US, there are formal processes to designate financial institutions and financial market utilities as systemically important. These rules could be applied to specific legal entities within big tech groups that provide specific services, like cloud computing for financial institutions, if the current definitions were to be revised. The current framework, however, falls short of allowing for the recognition of the potential systemic impact of incidents in big tech operations and of possible spillover effects to the financial sector and across all the activities they perform. For these and other reasons, regulatory actions in this area would benefit from close coordination among different financial and non-financial regulators, both at the national and global level. From a broader point of view, the rise of big techs has underscored how rapidly digital innovation can disrupt markets, even leading to new concerns around systemic importance. Authorities cannot be caught asleep at the wheel. We must invest into monitoring and understanding these developments so as to be prepared to act quickly when needed. In light of these challenges, the BIS has taken measures such as the new BIS Innovation Hub and Research on Innovation in the Monetary and Economic Department and Financial Stability Institute. Together with central banks and partners, we hope to contribute to stability and prosperity in our rapidly changing digital world. Thank you very much.
Thank you, Agustin. That was a fascinating discussion, not just about the roots of the remarkable success of the big techs, but also the fact that we cannot just rely on functional supervision. We have to consider entity-based rules. Let me now ask Bob Merton to offer his initial remarks. Bob?
Thank you. And I'm delighted to be here, and thank you for inviting me. This morning, I guess for me this morning, I picked two areas to focus on in terms of finances information. The first is the role of markets in producing information. The second will be the digitization of financial services and the role of information there. So on the first, the manifest function of major financial markets is transactions. But it has and always has had a critical latent function of providing information. So even a company, for example, who has no intention of issuing any new securities in the foreseeable or even long future will nevertheless monitor its stock prices, the stock prices of its competitors, its suppliers, because the market information there is essential for making good decisions within the firm. That this manifest function includes that the critical element that I want to say about markets, we know this, but it's worth emphasizing. Markets contain really important information, essential information, that no institution or no group of investors has, no central bank, no sovereign wealth fund, no collection of central banks has. Of course, big institutions, official institutions, have a great deal of information, private information, that is not generally available. But that information by necessity is only a partial part of the story in understanding what's going on. And markets, on the other hand, incorporate an incredible amount of information and aggregate it, particularly as we look at the transition of financial markets over the last 30, 40 years. And that was partly driven by fintech of the 70s, 80s, and so forth. Fintech in that sense isn't new, but it's still very important, which is the transition that markets are essentially become institutionally dominated. Market prices for stocks and bonds, fixed income, currencies, commodities are not being determined by college professors, taxi drivers, and ribbon clerks, if they ever were. This is an institutional market, and that has important implications in terms of the quality of the information and the nature of how that information is aggregated. On the quality of information, there's no question that the large institutions, often which have spent enormous resources on gathering information and transforming that into actions, but also that have information that no one else has in the market, through their actions in the market, of course, transmit that information into market prices. And we have to remember that, because what that says is that if it's more institutionally dominated, then it's at its value, it's weighted by size of transactions in general. That would suggest that the quality of the information reflected in that extraordinary aggregation is fairly high. And that's important. It's not, there's this sort of vision sometimes of markets being, run by crazy people or people who are subject to cognitive dysfunctions and trends and so forth, all of which does happen. But the key element is to go back to the source and recognize who's trading, what are their motivations for trading, okay? And, how that impacts price. Now, the globalization of markets, and despite all discuss towards nationalization and all that, I haven't seen any evidence of the reduction in globalization of the financial markets. That globalization means that, Asian institutions do transactions, they impact Europe, the United States, and the rest of the world's markets, and vice versa. And so it's a huge, very complex system, which markets remarkably are able to aggregate that information into some sort of collected use. And again, I underscore, use that has no institution has. This is in quite sharp contrast to some of the theoretical models that start with informed traders who know everything, and then noise traders and so forth, and act like markets are just a combination of those three. I think of it as much more that the institutions have real information, private information, valuable information, therefore should trade on it, but it's partial information. To get a picture of the whole, no one has it. And so when I look at markets more as an exogenous or a primary source of information, rather than simply an endogenous reflection of what the most informed people know, plus mixed with noise traders. That indeed, nobody knows all the pieces. And so, for example, when I look at markets, I have a view about where I look at the world, and I see markets in contrast to what I thought should be. I don't start my thinking by saying, what's wrong with markets? Who's messing up? Are they being driven by irrational exuberance, which they might be? But I start by saying, what am I missing? And I say all of this because I think the understanding of the importance of markets for information and the value of being able to incorporate that critical information with the private information that one has to get to sort of optimal forecast, I would, couldn't underscore more as a critical role. And that's why I'm going to spend my comments, including in the after discussion on these topics, on using market prices and market information to extract better knowledge and better understanding, and using the scraping, if you like, using fintech is the technical tool. I think it's a fair representation to say that tech is principally focused on scraping data from existing markets or from existing sources, going deeper, scraping it, and being able to analyze it and so forth. I would say that while that's certainly a very valuable thing, creating a new markets that will reveal as a latent function new information is going to have far bigger impact and take far greater advantage of the technology for scraping data than going deeper or relying essentially on existing markets. And so I think the development of new markets, the innovations of developing new markets are a central element to the increasing of information content. And in particular examples, powerful examples, you think of the option market. And by the way, options are embedded in almost every kind of security. So when I say options, I don't mean just literally the option markets, but any of the markets that have so-called non-linearities and so forth in the payoff functions. These can be extract enormous amounts of very, very useful and high quality information. And the benefit they have is that they're forward-looking. So if I do a typical analysis, let's say I want to get a forecast of future volatility of the stock market. Traditional way would be to look at historical volatility, look at the time series, et cetera, analyze that, and then come up with your estimate of volatility. And from that past, looking backwards, make a forecast what it will be in the future. The beauty of using the option markets is that through their structure, you could look at their prices and extract information directly about the future without having to look at the past. Okay, these are forward-looking because people buying and selling today are looking to the future, not just to the past, the way analyzing historical data does. Okay, and so this gives us change. This gives us a way of forecasting changes from the past. Now, when I say, what the ideal thing is to use both past data and forward-looking data, but these markets providing a forward look at what people believe in the aggregate, value weighted, okay, is, I think, a very, very rich area for us to be able to do that. If we're looking, for example, at the term structure, classically, people talk about forecasting future interest rates or so forth from the term structure and the implications of that. But the focus often is on expected values, first moments. Very little is said from those on the distributions themselves. What option markets do, including options on treasuries or floors and caps on LIBOR and so forth, give us is enormous amount of information, forward-looking information about the distribution. Volatility, the second moment is the most common. We all know the fear index, VIX, for example, but actually options will allow us, if there's a rich enough set of markets, to essentially get a complete empirical description of the distribution itself. I probably have a chance to comment that a little bit more later. I won't go into that in my introduction. And so this is being able to both understand future volatility and future other elements of the distribution. The risks around the expected value is going to be a great improvement. And again, technology will only allow us to do that more efficiently and more effectively. My second point has to do with the digitization of financial services, fintech. I think fintech offers a great, but enormous potential global opportunities to improve things, and that the improved services and substantially lower costs. And I believe that disproportionately those who are underserved now will benefit from that. So I would agree with my co-speaker here, Oscar, that the opportunities are great. And we've seen already the speed at which that's been adopted, reference to China and payment systems and elsewhere around the world. So I believe in areas such as that revolve calculations, processing and so forth, this is going to go very fast as it seems to be going. However, I would point out that the fact that it's going very rapidly in those particular areas, okay, does not mean that it's going to just rush through the whole of financial services activities in the same easy way. And let me try to identify what I think is quite important. That the tech story, and I'm being a little unfair to the tech people, is, it's going to be tech to consumers. Basically, everything in between is going to eventually disappear or become a utility. And that model makes some very a strong implicit assumption, and one that I don't happen to share. And the areas of which I think there are going to be a lot of headwinds for fintech are going to be those areas that are inherently opaque. And what do I mean by inherently opaque? They're opaque and you can't make them transparent. If something is transparent, you can see it, you know it, you don't need anything else. That's all the information you need. Just compare prices, for example. If it's inherently opaque, meaning you can't make it transparent, you still can use it if what? If what it does can be fully verified easily. So for example, Alipay or WeChat Pay or whatever certainly is not transparent and can't be made transparent. So how can it be so successful that retail will, hundreds of millions of people will use it? And I think the answer is verification. Verification, you try it, it works. Your neighbors try it, your friends try it, it works. And so you get very fast feedback that it works. And if it works and you can verify it, you don't have to actually understand it. Now, of course, we all know, and was alluded to in the opening remarks of Agustin, is that that doesn't protect against tail risk because they haven't had that experience. But it does explain how you can have something opaque that cannot, that can rapidly be done principally just with tech. Now, where are the areas though? Some areas don't allow verification, very good verification either. And one of the biggest areas is financial advice, both advice in my managing your money, but all advice embedded in every kind of complicated financial contract. And aggregated, very simple to use contracts are very nice for the consumer because they're aggregated, they're simple, they're to understand. The problem is they are totally opaque. And therefore, certainly transparency can't apply. So it's very difficult to say A and B are saying they offer the same solution or the same product, but to verify that they really are the same, it's not transparent. Verification of performance, anyone who's done that for a living knows, particularly things like managing stocks and so forth, is incredibly difficult. It takes a long time series to get something statistically significant. And because that's a mathematical concept, that would apply if we had an AI machine. Now you can use AI and big data to improve models to increase the amount of significance you can get from the data you have. But in general, it takes a long time to get statistically, scientifically based evidence that of performance. So if you can't verify and it's not transparent, then I would submit there's only one way that you can have such a product or service be used widely by consumers, and that is trust. And that's my second message. For big swaths of important financial services, you'll need, in addition to technology, trust. And when I say trust, I don't mean just trustworthy. I trust my grown children with making decisions on my life. They're trustworthy. I wouldn't let any of them operate on me because they're not competent. So you need, for trust, you need both competence and trustworthy. And that's going to be, in my judgment, a very important element, how the financial industry evolves under fintech. That once you have more than one factor of production, not just technology, but technology and trust, okay, then you have a more complex system. And this feeds back into the questions raised in the opening remarks by Agustin about traditional financial institutions vis-a-vis the new ones. And I would submit that when you think about the traditional institutions, for them to compete, they're going to have to learn and develop business models that take full advantage of fintech, whether they buy it or rent it. But it's a competitive market to get that information. You pay for it. So that doesn't seem to me to be an impossible barrier for traditional firms. They have, however, already important things. They have reputation. They have regulation. Think of those big banks that were alluded to, and we know the issues of the inconsistent regulatory treatments across non-banks and banks. But think of it from a point of view of trust. When something is completely, you have to depend on trust, regulation plays a critical role in that. And so I would say that the banks who are already regulated and are able to do with that, gives them a certain advantage. After all, if I won't name a particular bank, but you pick a great big global bank, if you had a choice of getting the same technology, the same pricing, and the same products from that bank versus a non-bank, knowing that bank is regulated by the Fed, by the Bank of England, by everyone under the sun, okay? And the bank also has large amounts of capital. And sadly, I mentioned this, we've seen they paid enormous fines in many cases, in the billions of dollars, and been stayed solvent. That's at least evidence that they have the resources to make good on mistakes they make for customers. I could raise the question. I think if we were getting the same technology and the same pricing, I think most of us for our important financial decisions would probably choose the regulated bank over the unregulated institution. So let me just complete my remarks in these opening remarks by just saying that I think it's going to be an interesting element to see how the tech companies and how tech companies in general and fintech get their technology trusted. Because I can assure you, and I could show you with more time, I could prove it to you, even for millennials, technology by itself is not trusted. And if you want the basis for it, everything that's technological is a model. Every model is an abstract from complex reality, therefore requires a decision about what the abstraction should be. That's the art of every science, and certainly the science of economics and finance. And so that's one of the elements. The other is data. Is it clean data, dirty data, biased data, no data, okay, that are used in the model? All of those things are reasons why technology, nice big black box machine sitting there, is not inherently trusted by itself. So I hope to open the thought process between the recognition of the important role of trust, and of course, with that credit risk, and with that innovation risk, and again, regulation as the core. I mean, just ask yourself in the areas of medicine, how many of us would put pills in our mouth or take vaccines where we have no clue, it's completely not transparent, and we have, why would we do that? Well, because we've had regulatory and other elements that provide an important part of, not complete, but important part of that trust. And you add to that business firms actually can develop in finance business models like independent fee-only financial advisors that inherently are models designed to engender trust. So I'll stop on those two elements, and I hope we get to discuss each in the ensuing time.
Thank you, Bob. Markets aggregate such incredible amounts of information that they must be considered the primary source of information. And then you also make the point that with fintechs, trust is so important. Um, Before I open the floor to comments and questions, I wonder whether Agustin would like to comment on Bob's point about the role of central banks in instilling trust. Agustin?
Yes, thank you. Thank you very much, Ellie, and thank you, Bob. Excellent presentation. I pretty much share all your views. Well, of course, the main business of central banks is to provide trust. I mean, I think that the main reason why our the currency that the central banks issue are in a way are competitive or have demand is because people trust the institution themselves. I mean, all the legal institutional arrangements around the central bank. These are no, it's fiat currency, and they're not backed by specific assets. And I think that's what the most valuable asset that the central bank has, and that's precisely the most valuable asset that the central bank needs to defend. And precisely the way we try to defend that is by pursuing financial stability and by pursuing price stability and to assuring that whatever is issued as cash or as money preserves the traditional roles of money, which is being a good medium of exchange, a unit of account, and a store of value. So and well, of course, central banks are usually the core from where many other, or pretty much all financial transactions evolve. For at the end of the day, you need settlement, and central banks are key for settlement to have finality. And for financial systems to work, I think trust is essential. And sometimes trust has to be, let's put it in quotation marks, imported. And the one way of importing it is through regulation. And I think that's another important role that central banks play.
Thank you, Agustin. So many deep insights and so many questions. Let me start off by asking Hans Genberg to lead off with a question. I think Hans has a question for Bob Merton. Hans?
Yes, thank you. Thank you very much. And thank you to both panelists for excellent, really excellent and interesting remarks. I would like to ask a question for Bob about how markets aggregate information. And I understand that they do. But then if central banks and financial market regulators use this information when they set regulation and policies, will that alter the information content? I presume it will. And does it matter? And if it does matter, is there a way to isolate the effect of the policy reactions from the other determinants of market prices and the information it contains?
Well, my quick first answer is yes, it can be done. If a central bank is going to have a policy to impact prices and is capable of doing so, then it obviously has to have some kind of model of the impact from its actions. I mean, you can't have a policy and say, we're going to do this by doing this action unless you have a model for how that action will implement that policy. So I presume there is a model there. And once you have that model, then, you can break out from that model, depending on, if the change that you're talking about are very large changes, it may take much bigger impacts. If it's very far away from sort of current market sort of sentiment, if you want to call it, or prices, that also, so it has to be a reasonably sophisticated model. But perhaps in this quick answer, let me just give you an example to illustrate how it could be done in something that I was part of some research on doing, which was a question of how do you measure government guarantees of a bank. And I don't mean explicitly, but implicit and explicit. And so what we did is the following. We used a CCA, that's contingent claim analysis. That's a three-word meaning. We use derivative models, which map prices of underlying securities into derivatives, or take derivatives to map it back to underlying prices. A guarantee is nothing more than a put option. It's insurance. That's the first thing. And so what we do is we say, we use well-used models that have been used for decades and decades by institutions around the world to take that bank using its stock prices, its bond prices, its option prices, any of its traded security prices, we can use to extract information which would allow us to work out what the put option or the guarantee would be worth on the risk of the bank based on market prices. Okay, they're traded market prices. So that's the primary source. All right. Now, once you have that, all right, that prices the total credit risk of the bank, both credit risk borne by the private sector, but also credit risk borne by the government or the public sector. Okay, because that's the risk of the bank.
Right.
We then take CDS on that bank. Now, what is CDS? CDS is not on the total credit risk of the bank. It's on the part of the credit risk of the bank that's held in the private sector or in the non-official, it's not the government. So, for example, just so you get what I mean, when Ireland guaranteed all its banks back during the crisis, the CDS of those individual banks fell enormously in price. Why? Not because the banks have become less risky as banks. It's just that the risk of the banks have been transferred from the private sector to the government. Of course, the CDS on Ireland went way up, but that's the side. So now we have two things. We have a model that gives us the total credit risk guarantee value. We have the CDS, which gives us a market price for the private sector risk of bearing of that credit. And the difference gives us a clear estimate of the value of the public guarantee, both implicit and explicit. That's just a very simple example of how you can take account of different policies, which would of course affect how much the government is engaged in taking on the credit risk versus the private sector. But this is an example that you can back out separately, that part which comes from the policy or imply, that is being followed from the rest of what's going on. So I hope that.
Thank you. Thank you. Very, very clear. Thanks.
Thank you, Bob. Thank you. Let me now ask Anela Monroe. She's a professor at the Asia School of Business. She has a very good question for Agustin. Anela?
Thanks, Ali, and thanks to our two panelists for really interesting remarks. So my question is about payment services for Agustin. So this running start that big tech companies have, it seems to give them advantages in the provision of payments. So I guess networks and technology and data, and then the data that they get from payments feeds back. And in China, the big techs already have a huge dominating position in mobile payments. And even in India, where there's a common payments infrastructure, we've got big techs as the biggest four, or big tech partnerships in the provision of services, which is meant to be more of a competitive framework. So what can the authorities do to mitigate that kind of market dominance while ensuring the stability and integrity? And I guess I'm thinking more as central banks as authorities. Thank you.
Yes, thank you very much. Well, I mean, we have to start from the point of view that big techs developed extremely rapidly. They entered into financial transactions as a side effect of the huge network they have. And with regard to commercial banks, they have an advantage. And that is that the regulation on the use of information of individuals is different. I think the main informational, and in this way, the points that Bob made are extremely useful. I mean, big techs are in many markets. They extract information from all those markets, they organize it, and then they reflect it in the services they provide. They in a way, the way information is used there is far more flexible than what we allow banks to do. So there is an issue that needs to be analyzed. I think that a big part of what the regulation going into the future will have to do is to apply and develop more what I would call the economics of information. You know, who owns data, who is entitled to use data, how can data be shared. I think also we need to find out how data can be stored, if it can be moved from one country to another. I think that is a tremendously open field, and as the lines between traditional financial intermediaries and new financial intermediaries like big tech appear, the different use and the different, let's say, command they have on the use of information and exploitation of information is what can make a huge difference. So I think to develop this aspect of economics of information is really part of the essence. I mean, I think at the end of the day, what I would like to say is my comments should not be interpreted as I want to protect banks. I mean, I think banks has to do their effort. As Bob say, they are very active in buying startups. They are investing a lot in fintech and so on, and so on, and so forth. But you know, it is like having a dog fight. I mean, in Mexico you have dog fights, and sometimes when you're a politician, they tell you that you are like a dog from a ranch, and a dog for the ranch is a dog when there is when there is a party, you are tied up. When there is a fight, you're unleashed. I feel that in this case, traditional banks are tied, and the fintechs are running around them and attacking them all the time, because they are not subject to the same type of flexibility in the use of information. Part of the information limits on banks has to do with privacy, and that is also a very important societal aspect. So my sense is that we need to think far more about what is an equitable use of information. And then also the starting point is very different from the point of view of regulation. And in a way, that is what I was trying to get in my presentation. So I mean, there are multiple aspects where we need to think about. As I say, at the end of the day, it has to do with the DNA aspect, which is data, networks, and activity. And data has to do with privacy, has to do with how much regulatory limits are in the use of information. Networks has to do with competition. Activities, by and large, has also have to do with financial regulation. And this problem is so complex that I think that the three areas of regulation have to interact very agilely. I mean, we cannot have silo aspects or silo treatments as we traditionally have.
Thank you. It's really useful perspectives on the whole information space. Thank you.
Thank you, Agustin. I think Patrick Honohan has a question for both Bob and Agustin. Patrick?
Thank you. Well, my question maybe moves a little bit in the same direction, but a little bit beyond what Amelia has asked. And that is to ask, with the big techs growing and growing and accumulating information, not just in the financial markets, but in the other aspects of what financial market participants are doing and thinking. Could we get to the stage, accepting and starting from what Bob Merton has said, that information, nobody, no entity, no group of entities has all the information that gets embodied in market prices? Could we be moving away from that, in that one or two of the very big techs could accumulate so much information from their knowledge of what participants are doing and everything else, that suddenly information could become in some way monopolized? And that would change the way in which we think of finance as being an accumulator of information and a clear signal of information.
Thank you, Patrick. Bob, you want to go first?
Okay, well, I'm not an information expert. I would say the following, that first is to, I'm not, when you look at a business, let's say one of them that collects this incredible amount of personal information and so forth, that doesn't mean that they are also the best user of that information. So just because I have good information about people doesn't mean I'm a good lender. I may not have the credit skills. I may not have the locational skills. There are many inputs. This is not just driven by information alone. And it's inconceivable to me that the largest of firms, the same reason we don't have one bank for the whole world to economize on clearing or settling, is that we have various comparative advantages. So one model would be that after proving that the information that the big techs get is valuable, let's say for credit purposes, they then sell that information to whoever wants to do the credit business. That would seem like a very profitable, the most profitable way, and for them to stay out of it. In the same way that Henry Ford used to grow trees so he could burn them in the furnaces so they could build the steel. That isn't the most efficient way. So that's my first response, just on that. The second one is, I don't think any of us, it's really hard to fathom how much information is being embedded in those trades in the marketplace, coming from everywhere for all sorts of reasons, from informed sources. And then the process of aggregating that, which markets do. And that information is available to everyone. That's my point. It isn't as though they're going to know all the information that's useful in the world and the rest of the world is left dependent on just them. That can happen in a certain area, like any monopoly. But I don't think in general information of that sort they have any particular advantage in gathering that information, let's say, on what institutional investors are doing over, and big banks, any kinds of financial firms that are really quite skilled at using technology and buying technology in order to do that.
Thank you.
My answer would be slightly different. My answer, in precisely using this DNA process that I delineated in my presentation, which is part of our chapter 3 of last year's annual economic report of the BIS. The problem is that they have found extremely good ways of exploiting that information. They have been accumulating huge amounts. They have put together a tremendous quality of algorithms that exploit that information, and it really gives them a tremendous advantage. I think that precisely the very unprecedented growth that Alibaba, Tencent, and others have acquired is precisely because they have this ability to accumulate and exploit that information. And that exploitation of information gives them a tremendous competitive advantage, just because that information is not accessible to anybody else. And precisely this loop is what making Amazon, Google, Tencent, Alibaba have a higher and higher and higher market share, where others are just out there watching it, So that's why, as I say, we need, this idea of developing a market for information is a very valid one. And I think we have to think more about that. But it can be tremendously disruptive, I think. And that's why there is a need for regulation. There is another aspect that is very important, and that is the fact that they start knowing your tastes. I mean, if you combine information from what you buy through the internet with your transactions, they will know, you know, even what color car are you planning to buy in 3 weeks, you know, and then that can lend itself into discrimination, extracting more benefits out of you. So I think this is a completely new game, and I think that we need to look into it very seriously and very quickly too.
Thank you, Agustin. Can I ask a question as a moderator? Can I ask you, Agustin, about this DNA loop? In the presence of this DNA loop, how different do you think central banks of the future will be? What will change? Can you speculate on that in the way central banks operate?
Well, I mean, I think at the end of the day, and I go back to a discussion we had after Bob's presentation when he mentioned trust. I think we have to preserve that element. We need to be able to provide that trust, and I would say export or expand the reach of trust to other, probably other representations of money. I mean, there is a lot of discussion nowadays on CBDC, central bank digital currency. That's something that society is probably expecting from central banks. So how should we respond? Well, we need to respond in provided a trusted digital currency that differentiates itself from other digital currencies that are out there. And that's a huge challenge. So I think that the challenge for central banks, and that's what will differentiate them, is that we will need to constantly find which is the most technologically appropriate way to provide central bank money, which is trusted money to society. And I think that's the way we have to move. I also think that something that Bob mentioned, and it's part of the response of Hans Kemberg, is very important, and is that we need to internalize all this information also for our policy making, not only regulation and in supervision, but also I would say for policy making. You know, I mean, for example, in monetary policy, we all know that inflationary expectations are really important. Now there is huge amounts of information out there about inflationary expectations, are forward-looking. You know, there are markets for future CPIs, option CPIs. We need to use all those moments, all those information to extract better information, to see what really people are expecting, what is happening out there, and incorporate that in our way of doing business. So, I mean, I think that the challenges is a far more savvy central banks in the exploitation of all this information, and being technologically savvy to provide the type of cash that society expects in the modern world.
Thank you, Agustin. I'm afraid we're running out of time. So many questions. I think I'll ask the panelists to offer their final remarks. Let me start with Bob for your final remarks, Bob.
Okay, first, I certainly did want to imply that I didn't think there were all the information issues. I just wanted to counter the implication of the question of it automatically going to a monopoly. But let me say that the elements that I'd like to underscore is, one, again, the issue of trust and the role of regulation, and that the critical element is that technology needs that. Secondly, I'd like to point out the amount of information that can be gathered from option markets or those kinds of markets. Just think for a minute, think of the cap and floor market. where there are so many different strike prices, 4.1%, 4.15%, et cetera, for very many dates. If you take a floor where I buy a floor of 4.1% and sell a floor of 4%, you realize I have an instrument that pays nothing unless the interest rate is between 4 and 4.1%, right? That's a digital instrument. That gives us a price for each, essentially for each interest rate at every forward date for delivery that those markets are there. That, because we know probabilities in almost every equilibrium model you can design are proportional to those prices, then that allows us completely to develop an empirical distribution with no distributional assumptions from these market prices, every aspect of it. And I'll mention one use because I think it's so important. When Ben Bernanke announced he was taking interest rates to 0 in December 2020, looking at those digitals that we looked at, we saw the probabilities, forward, let's say 3 years, 90 days, 3 years forward, move immensely down, as you would expect. But very interestingly, in March, when he announced he was going to continue indefinitely the very low interest rates, the reaction was quite the opposite. Rates 3 years, 90 days, 3 years forward, moved in the opposite direction. They actually went up. So this is a feedback that you can get from that kind of market to a central bank on what the market's reactions are that is far more detailed and far more precise than just looking at the movement broadly of interest rates. So I'm very excited about the opportunities here for us to do much better. But there is one question that sometimes gets confused. If we have much better information, the tendency is to believe that will reduce volatility. And it will in the short run. But then when we find ways to get volatility lower because we know more, we tend to get the benefit not by keeping volatility low, but by willing to take on risks that weren't prudent, but now become prudent because we can control them better. And so we have to be very careful how we measure things. We shouldn't expect necessarily volatility to go down with improvements, but it will be beneficial because we'll be able to do more things more efficiently. So anyway, those are my two thoughts, and it's going to be an exciting future.
Thank you, Bob. This all makes me feel so intelligent. Unfortunately, we're out of time. So let me just thank Bob Merton, Agustín Carstens for a very fascinating discussion. I apologize to those who haven't been able to ask their questions. I hope we'll have another opportunity for a webinar like this. But thank you, Bob. Thank you, Agustín. And thank you for the rest of you who've attended this webinar.
Thank you all. Bye.
Bye.